2 in 5 Canadians say they're within $200 of not meeting their bills each month. If that's you, understanding what happens to your assets in a consumer proposal versus bankruptcy could be the difference between relief and panic. This video shows you exactly what's protected under both options. Coming up in this video, you'll learn what you can legally keep and what's actually at risk in a consumer proposal and bankruptcy in Canada. We'll cover household goods, vehicles, tools of trade, and how provincial exemptions work. Then we'll talk about what happens to your savings and benefits, RRSPs, TFSAs, RESPs, pensions, and tax refunds. And finally, discuss if you can obtain new assets while in a consumer proposal or bankruptcy. We'll break down how new assets like tax refunds, bonuses, inheritance, lottery wins, or buying a new car are handled differently under each option. Let me start by busting a myth quickly. I'll lose everything if I do a proposal or bankruptcy are usually false. Exemptions exist to protect what you need to live and work. For example, you need clothes to dress and a vehicle to drive to work. Here's the key difference you need to understand. In bankruptcy, you're surrendering your non-exempt assets to the trustee for the benefit of your creditors, while in a consumer proposal, you keep your assets and instead offer monthly payment to your creditors. Let me define a few terms so we're on the same page. Exempt assets are things the law says you can keep. Non-exempt assets are things that could be taken to pay your creditors. Debt is backed by something like a car loan where the car secures the loan. Unsecured debt has no collateral like credit cards, and equity is what's left after you subtract what you owe from what is something's worth. In bankruptcy, non-exempt property can vest in the trustee until you're discharged. This means you have a duty to disclose windfalls during the process. In a consumer proposal, you keep ownership while making agreed payments based on what creditors will receive in a bankruptcy scenario. Now let's talk about exemptions. I'm in Ontario, so for this video, I will only be referring to exemptions in Ontario. Keep in mind, these amounts can vary in every province, so always confirm current limits before making any decisions. Your clothing and your dependents' clothing is unlimited. You can keep all of it. Household furnishings and appliances are protected up to $14,180. Tools of trade are exempt up to $14,405. One motor vehicle after subtract any loan balance is protected up to $7,117. Principal residence equity is exempt up to $10,783. And here's an important one. RSPs and RIFs are exempt, except for contributions made in the last 12 months. That's a federal rule that applies across Canada. Most people don't lose the basics they need to live and earn. Let's talk about your home and mortgage and see if you can keep them in a bankruptcy. Like I said earlier, in a consumer proposal, you keep all your assets like your house. For a bankruptcy, you need to calculate your equity first. Here's how the equity math works. Take the value of your home, subtract your mortgage balance, any liens, subtract selling costs, and divide by the number of owners. What's left is your equity. Let me give you an example. I had an Ontario homeowner with a house worth $1 million and a mortgage of $838,000. After the estimated selling cost of $62,500, he's left with equity of $50,000, which was above the principal residence exemption. If he chose bankruptcy, he'd have to pay that $50,000 into the estates, often through what we call a buyback arrangement, or risk having the house sold for the creditor's benefit. If he chose a consumer proposal, his house wouldn't vest to the trustee. He'd keep his home by making proposal payments that would reflect what creditors would receive from that $50,000 if he had filed for bankruptcy. He just have to stay current on his mortgage payments to keep the house. Think of it this way. Bankruptcy means paying or facing sale risk. Consumer proposal means keeping your home and making payments up to 60 months to the trustee for your creditors. Now let's talk about registered plans and savings. RSPs and RIFs are exempt except for contributions in the last 12 months. That's a federal law under the Bankruptcy and Insolvency Act. However, if you keep these accounts at life insurance companies with preferred beneficiaries, like your spouse or kids, when all contributions will then be fully exempt, including contributions in the last 12 months. Tax-free savings accounts are not specifically exempt under federal law the same way RSPs are. Provincial insurance structures may also differ, but generally they're not protected the same way. RSPs in Ontario are generally not exempt in bankruptcy. Typically, only the contributions you made would be exempt, but any grants or income on the investments are not. In a proposal, you can keep your RESP, but your offer still has to be fair to your creditors. Pensions and certain life insurance are generally protected depending on the plan type and provincial rules. Here's what happens with taxes and credits and refunds. In a bankruptcy, tax refunds for the year of the bankruptcy and prior years usually go to the estate. They get sent to the licensed insolvency trustee. In a consumer proposal, you typically keep your tax refunds, subject to set off by the Canada Revenue Agency if you owe them money. Sometimes many people have vehicles which they own, so the trustee will need to calculate whether it's exempt or not. If you had a vehicle worth $10,000 and the exemption amount is $7,170, you'd pay $2,813 to the trustee to keep the asset in a bankruptcy. Now let's discuss what happens if you acquire assets while in an insolvency. In bankruptcy, before you get discharged, inheritances, lottery wins, large gifts, and settlements are usually considered after acquired property that's payable to the estate. You have to disclose these to the licensed insolvency trustee. For example, if you had a family member pass away and leaves money or a house to you, you'll need to surrender it to the trustee to pay towards your creditors. In a consumer proposal, assets do not vest in the trustee. Windfalls are generally yours unless the proposal terms say otherwise. This often lets you pay off your proposal early if you want to. Let me tell you about some compliance and pitfalls you need to avoid. Do not hide or transfer assets. Disclose windfalls promptly. Follow all your duties to avoid discharge or approval issues. In both a consumer proposal and bankruptcy, you can keep your secured assets. For example, if you're financing a vehicle, you can keep the asset as long as you keep making the monthly payments to the lender. Let me share a story about the importance of full disclosure. I once had a client whose business failed and he accumulated lots of personal debts with minimal income. So he decided to go bankrupt. However, 3 months after filing for bankruptcy, we discovered he had a whole life insurance policy which wasn't disclosed when he filed his bankruptcy because he forgot about it. We confirmed the life insurance policy with his insurance company and they said it had a cash surrender value of $10,000. He had no preferred beneficiaries like a spouse or child, so this asset wasn't exempt from bankruptcy. He could have either surrendered the life insurance policy to us and we would cash in the value of the policy for the creditors, or he could pay $10,000 to us to keep the life insurance policy. He had the policy for many years, so he decided to purchase it back from us for $10,000 so he could keep it. This shows you why you always need to make sure you disclose everything so there's no surprises later. To recap, in a consumer proposal, you keep all your current and future assets. A consumer proposal is just like a contract with your creditors to make an agreed payment to the licensed insolvency trustee, who then pays the funds to your creditors. In bankruptcy, you may or may not keep all your assets. But in a consumer proposal, you always keep your assets. Keep in mind that in bankruptcy, you don't just have to surrender assets, you also have to make monthly payments to your trustee based upon your income, which is called surplus income. The higher your income, the more you may need to pay monthly to the trustee for your creditors. Remember our Ontario homeowner with $50,000 equity? Bankruptcy meant losing the house or paying that full equity into the estate. With a consumer proposal, he kept the home and turned that at-risk equity into affordable monthly payments for his unsecured debts. If assets you want to protect, a consumer proposal might be the right option for you. The next step is knowing exactly how to file one properly and confidently. You've learned what you can keep and how assets are treated. Now you need to move from theory to action with the filing workflow. What to prepare, what to expect, and common mistakes to avoid. The next video delivers the step-by-step process, how to file a consumer proposal in Canada. You'll learn what to gather, how the offer is set using the bankruptcy benchmark to determine what creditors will receive in a bankruptcy, the timeline and votes, what happens after filing, creditor voting and approval mechanics, payments and setup, choosing your terms, and early payoff options. If you're serious about protecting your assets and getting relief, the next video shows you the exact steps to file a consumer proposal.